Market structure alone won't make you profitable. Neither will SMC, order blocks, or fair value gaps. If it were that easy, everyone would be a millionaire by now. But when you combine these concepts with time of day and liquidity, you'll gain the power to predict the market with precision most of the time. More importantly, you'll know when to step back and avoid bad trades, because knowing when not to trade is what separates pros from amateurs. Stay tuned, because I'm about to break it all down with real-life examples. Let's dive in. This video is divided into 3 parts: market structure, the foundation of price movement, how to spot liquidity, where smart money plays tricks, lower time frame confirmations, how to time your entries like a sniper, and at the end, I'll show you a real trade. I took this week using all of these concepts combined, so make sure you stay till the end. Market structure, the blueprint of price action. Market structure is basically the roadmap of price. It tells us where the market is heading. And in trading, price doesn't just move randomly, it follows patterns that reveal trends. We have 3 types of trends. Bullish trend, when price keeps making higher highs and higher lows. Bearish trend, when price makes lower lows and lower highs. Consolidation, ranging market, when price is just chilling sideways, trapping traders left and right. Now, how do we identify the trend? It's actually simple once you see the pattern. In a bullish trend, price pushes up aggressively. This move is called a higher high. Then it pulls back. That retracement is a higher low. As long as price keeps breaking previous highs and forming higher lows, the trend remains bullish. In a bearish trend, price drops hard. This move is the lower low. Then it retraces up a bit. This is the lower high. Just like in bullish trends, price extends, then retraces before continuing downward. As long as price keeps breaking lows and forming lower highs, we stay bearish. Break of structure and change of character, the key to trend shifts. Break of structure. This happens when price breaks the previous higher high, confirming that the trend is still going strong. Think of it as the market saying, "Yep, we're still moving in this direction." Change of character. But what if price suddenly breaks the previous lower high in a downtrend or higher low in an uptrend? That's a change of character. Like the name suggests, this means the market is shifting gears. It's no longer just continuing, it's hinting at a possible reversal. Important rule: a break of structure should happen with a full body close, not just a wick. Wicks can be liquidity grabs, which we'll cover in the next section. Now that we understand market structure, let's move on to the real secret: how smart money uses liquidity to trick traders, and how you can avoid the trap. Part 2. Liquidity. How smart money traps retail traders. All right, now that we understand market structure, let's talk about liquidity, the reason why most traders get stopped out right before the move they were waiting for. If you've ever placed a perfect trade only to get stopped out by a tiny wick before price flies in your direction, congrats, you were liquidity. What is liquidity? Liquidity is basically where orders are sitting in the market, and guess what? Smart money knows exactly where retail traders place their stop losses. They hunt them before making the real move. Now, let's break it down with 3 main liquidity concepts: weak highs and weak lows, why they get taken out. A weak high is a resistance level that price has rejected before but failed to create a strong move away from. A weak low is the same thing, but in a downtrend, it's a support level that price keeps testing without a strong bounce. Why do these get taken out? Because retail traders keep placing their stop losses there. Example: price reaches resistance, traders short, stop losses sit above. Smart money pushes price up, grabs those stop losses, and then the real move happens. Same thing happens with weak lows in a downtrend. Price sweeps below, grabs liquidity, then reverses. Key lesson: a weak high is likely to be broken in a bearish trend. A weak low is likely to be broken in a bullish trend. Because weak highs form in a downtrend, meaning price is likely to break above them to grab liquidity before continuing lower. And weak lows form in an uptrend, meaning price is likely to break below them before pushing higher. Support and resistance. Liquidity traps. Most traders love support and resistance. They see a strong level and think, "Oh, price will bounce here." Smart money, on the other hand, sees a stack of stop losses sitting below that support, or above resistance, and they use that liquidity to fuel their positions. Example, imagine price bouncing off support multiple times. Retail traders start buying aggressively. But right below support, a pool of stop losses from buyers. Smart money pushes price below support, stops them out, then reverses. Key lesson: true reversals happen after liquidity grabs. Trendline liquidity: most traders love trend lines. They think, if price respects the trend line 3 times, I'll enter on the 4th touch. Wrong. Smart money sees trend lines as liquidity magnets because retail traders place stop losses below an upward trend line, expecting it to hold as support, and above a downward trend line, expecting it to act as resistance. When too many traders follow this pattern, smart money manipulates price by sweeping these stop losses, dropping below an upward trend line before reversing higher, or spiking above a downward trend line before crashing lower. This stop hunting move allows institutions to fill their positions before the real trend continues. Example: price respects an upward trend line multiple times. Retail traders start entering aggressively, placing stop losses below. Smart money sweeps below the trend line, grabs their stops, then reverses back up. Key lesson: never trust a trend line blindly. If price keeps touching a trend line, expect a liquidity grab before the real move. Why your stop loss keeps getting hunted? You're placing stops where everyone else is placing them. Smart money needs liquidity to execute big trades, so they go after your stops first. The real moves often happen after liquidity grabs. So instead of placing your stop where liquidity sits, wait for the sweep, then enter. Part 3. Lower Timeframe Confirmations. Now that we've covered market structure and liquidity, let's talk about how to time our entries like a sniper using lower timeframe confirmations. Price is fractal. Same patterns, different time frames. Think of price action like Russian dolls. The same structure repeats on every time frame. Whether you're looking at the 4-hour chart or the 1-minute chart, price follows the same patterns. This is why we start by analyzing the higher time frame bias, like the 15-minute or 1-hour chart, and then drop down to lower time frames, like the 1-minute, for precise entries. Example: on the 15-minute chart, price sweeps liquidity and shows signs of reversal. On the 1-minute chart, a clear market structure shift confirms your entry. In 15-minute, identify the trend and liquidity grab, if price is in an uptrend or downtrend based on market structure. Look for a liquidity sweep, where price takes out weak highs, lows, support and resistance or trend lines, and then rejects aggressively. This indicates that smart money is hunting stops before reversing the market. Mark the supply zone in a bearish or demand zone in a bullish, around the last major move before the structure shift. This is the area where smart money will likely enter on a pullback. Now go to 1-minute price will likely pull back into the 15-minute supply-demand zone. Then wait for a change of character on the 1-minute chart. If price was making lower lows and lower highs but suddenly breaks a lower high, this indicates a bullish change of character and signals a potential reversal to the upside. If price was making higher highs and higher lows but suddenly breaks a higher low, this signals a bearish change of character and a potential downtrend. Now, let's combine these concepts and go over the exact trade I took. When I opened the chart, the 15-minute trend was clearly bullish. The first thing I did was mark my liquidity pools. For example, there was a clear trendline liquidity here, support zones there, and weak lows all in one place. Next, I marked out my demand zone since we were in a bullish trend. This meant I wouldn't enter any trades until all these liquidity pools had been cleared out. Now, let's see what happened. Did you notice how price tricked early buyers into entering too soon? It gave them a fake signal, only to completely wipe them out before heading to my demand zone. Once price reached my demand zone during the New York session, I waited for a change of character on the 1-minute time frame. When I saw confirmation, I placed a buy limit order. Now let's see how the price played out.